we're trying to do here. What we want to do is, and I apologize, seem to be having a little computer problem here. What we're trying to do is we're trying to transform a list of transactions into financial statements. So we can keep track of our transactions. We have our transactions, which are things like we've been talking about. You sell something, you buy something, etc., etc. And what we want to do from that is we want to create financial statements, a balance sheet, an income statement, things like that. So you want to know, for example, we'll have a list of transactions. We want to know what total cash is. We want to know what payables is, what is revenue, what is expenses, what's the statement of stockholders' equity look like, even what does a cash flow statement look like. And that's the information that we need. So the information that we'll start off with are the transactions themselves. And this is all explained. I tried to bring up a copy, and I couldn't do it on my computer for some reason, but a copy of the beginning of the chapter 7 in your book. But you can see this all explained there in terms of the different steps. What we want to do is we want to transform this list of transactions like we have here. Here you can see several transactions the company had, and use this information, slice and dice it in a way that we're going to be able to create financial statements. So one way to do it is with this chart. The problem with the chart is that it can't handle very many accounts or transactions. It's very space intensive, and it would be easy to make mistakes this way. Another problem is, keep in mind what I told you about when people started keeping serious accounting records was in the 1400s, the 15th century Venice. And at the time, there were no calculators, there were no computers, there were no pencils, okay? People used pen with ink, with a feather and stuff. So we're talking about a different time here. So the idea was to create a system where you could take a list of transactions and transform them. You somehow slice and dice them and reorganize them so you could have financial statements. And that's what the debit and credit system does. So what the debit and credit system does is it basically sets up accounts. So there are two kinds of accounts, what we call debit accounts and credit accounts. And I'll just add to this that debits, the asset accounts are going to be debit accounts, and the liabilities and stockholders' equity accounts are the credit accounts. Again, very important. Asset accounts are debit accounts. Liabilities and stockholders' equity are credit accounts. So the total of the debit accounts, which you can see here on the left, is equal to the total of the credit accounts, which you can see here on the right. And we're trying to construct this system so there's as little subtraction as possible. On a practical level, it's easy to add up. Remember from math, it's easy to add up a sum of numbers. It's not easy to subtract a long list of numbers. So what we want to do is we want to create a system where we can add up long columns of numbers and occasionally subtract a number, but we won't have a situation where we have a long column of numbers, some of them positive and some of them are negative, and we have to add them all up. Because that was hard to do in the 1400s. It was hard to do before you had calculators. So instead we have debits and credits. Assets are debit accounts, liabilities and stockholders' equity are credit accounts. Now, they have opposite characteristics, and that's why it's really important to keep them straight. Debit accounts are increased by debiting them and decreased by crediting them. Credit accounts are increased by crediting them and decreased by debiting them. Let me repeat that because it's really important. To increase a debit account, you credit it. To decrease a debit account, you credit it. To increase a credit account, you credit it. And to decrease a credit account, you debit it. So if you mix up your debits and your credits, then you will increase it when you intend to decrease it, or decrease it when you intend to increase it. And that's a big problem. So know, first off, that assets are debit accounts, liabilities and stockholders' equity are credit accounts. And it's just axiomatic. That is just how it works. And they must be equal because assets must equal liabilities plus stockholders' equity. So let's answer some questions and then we'll get to the interesting part. When amounts are correct, the accounting equation will always be in balance. Similarly, debits, will or will not, will always equal credits. Now, what I want you to do here is answer the next question, 3 questions on your own, and then we'll go over it. Assets, then, are what? You just say the answer. Assets are debit accounts which increase with a debit and decrease with a credit, whereas liabilities and stockholders' equity are credit accounts which are increased with a credit and decreased with a debit. Critical fact, and you want to really know this. Cash is a what? Asset, liability, stockholders' equity is an asset which is a debit account which is increased with a debit. Therefore, to record an increase of 30,000 cash, the journal entry should debit cash. Debit cash increases it. Crediting cash decreases it. Common stock is a stockholders' equity account, which is a credit account, which is increased with a credit. Therefore, to record an increase of 30,000 in common stock, the journal entry should credit stockholders' equity. Now, remember what we said about stockholders' equity before. We said that, and I showed you this before in my own printout, stockholders' equity equals common stock and retained earnings, right? Beginning retained earnings plus net income minus dividends is ending retained earnings, and net income is made up of 2 components, revenues minus expenses. So you could say that beginning retained earnings plus revenue minus expenses minus dividends equals ending retained earnings. Okay, fine. So what we would do here is stockholders' equity is on the credit side, revenues is on the credit side, and what you could say is that expenses or dividends are subtracted from the credit side. But instead, because we don't want to do subtracting, we just want to do adding, we're going to add them to the debit side because they're negative credits. You follow me? Expenses are subtractions from stockholders' equity, so I'm going to make them debit accounts. And dividends are also going to be debit accounts. So, retained earnings is increased by net income and decreased by dividends. Hence, revenues have what effect on retained earnings? They increase retained earnings, whereas expenses and dividends, what effect do they have on retained earnings? Decrease retained earnings. And this leads us to the big picture here. Retained earnings is a stockholders' equity account because revenue increases stockholders' equity. Revenue is recorded with a, because revenue increases stockholders' equity, revenue is the same side as stockholders' equity, right? It's really part of stockholders' equity. So revenue is recorded with what, a debit or a credit? A credit, because it's really part of retained earnings. Because expenses and dividends decrease stockholders' equity, they are recorded with a debit, because they're subtractions from stockholders' equity, just like I showed you up above here. Likewise, down here. Now, this is the grand map. And you can tattoo this on your arm or something so you don't forget it. Well, but then you'd have to cover it for the exam. This is everything in one little picture. Debit accounts are assets, expenses, and dividends. Credit accounts are liabilities, stockholders' equity, and revenues. Now, let me help you avoid confusion here, because this is where there frequently is confusion. Forget what you know about debits and credits and the normal meaning of these words, because debits are not bad and credits are not good or anything like that, because if you look for things that they have in common here, what you initially think won't work. So you might think that revenues are good, right? So, and they're credits. Well, so are liabilities and stockholders, so are liabilities. Liabilities are not good. So a credit could be an increase to a revenue, or it could be an increase to a liability. So thinking that credits are increases only is missing half the show, and you're going to get half the problems wrong. Likewise, when we're talking about debits, you might say debits are bad because expenses are bad, or debits are subtractions because credits are additions. They are for some accounts. But look at what my debits are. They don't have much in common. Assets, expenses, and dividends all seem to have different kinds of things in common. Assets are things that you own, whereas expenses represent expiring of resources. So if you look at the debit accounts together, you'll see that they don't seem to have very much in common. And likewise, if you look at the credit accounts together, you'll see that they don't seem to have much in common. Let me explain what they do have in common. Credits tend to be sources of revenue or funds, whereas expenses tend to be uses of funds. So if you're financing your business and you need cash flow, there are 3 places you can get it from. One is revenue, sell more stuff. Another one is stockholders' equity, raise capital from your investors. And still another one, is liabilities. You could borrow money. So credits tend to be sources of funding. Debits, on the other hand, tend to be uses of funding. What are things you could spend money on? Assets. I could invest them in assets. I could have expenses. Expenses cost money. And I could also pay dividends to my shareholders. So thinking about it that way, these credit and debit accounts have those things in common. But you should dismiss the general idea that credits are always pluses and debits are always minuses. Some students think that and they get a lot of things wrong. Or that credits are good and debits are bad, because that doesn't work. Rather, the credit accounts are liabilities, stockholders' equity, and revenue. The debit accounts are assets, expenses, and dividends. And, if you have to, write it on a card, keep looking at it until you really know it. Because all the information in this little box right here is really key to understanding everything we're going to do in the rest of the course. Debits are assets, expenses, and dividends. Credits are liabilities, stockholders' equity, and revenue. Now let me show you what we're going to do with them in step 1.